Hello, everybody. My name is Cady. Thank you for coming. I'm with Steve Hawkins, Pete Stottlemeyer's partner for many decades, and we're here to give a free introduction and sort of where we are with Market Profile, which seems to be having a moment these days. And I'm glad you can join us. We'll try and keep it entertaining. Don't be afraid to ask us any questions in the chat. Don't be afraid to reach out to us later, through either social media or email if you have any questions. And with that, I will introduce my friend Steve Hawkins is really responsible for me being involved in all of this Market Profile since 1991. They came to the NYMEX, where we trade crude, and COMEX, where we trade gold, and they taught a class for a week every day after trading about how the future was going to be in having to segment data because you weren't going to be able to stay awake during 24-hour marketplace. And so Market Profile has evolved with the times, and its premise is to essentially to be in step with an organic process that's taking place. And with that, I will hand it over to Mr. Hawkins, Steve Hawkins.
Hi, thanks, Chris. Thanks for the introduction. As Pete said, I've been working with Pete for going on 30 years now. It's hard to believe it's been that long, but it has. I think I started working with him right out of university in the late 80s, and then here we are, 20 years later, or pardon me, 30 years later, and over that time, there's been a lot of changes in the markets, and more importantly, changes in the way we look at things, relative to the market profile. Pete developed the profile in the early 80s for the Board of Trade. With the development of the profile, it was essentially backed by the Board of Trade, and their goal was to try to generate more interest in trade for the exchange. And so they went back and forth on what was a good way to do that. And looking back at your statistics classes, I assume that all of you have seen the Gaussian distribution. People have taken stats classes, and Pete thought that maybe that would be a good way to organize data. He flipped it from a horizontal to a vertical display, and lo and behold, you have what you see in front of you, which is a profile. And the basic building blocks of the profile are very, very simple. Looking at, everyone's familiar with bar charts. People look at different resolutions of bar charts, 1 minute, 5 minute, whatever they're looking at. But the legacy market profile does nothing more than take a half-hour segment and assigns a letter to it. As you see on the screen right now, you're seeing a bunch of letters built vertically on top of each other, and that represents the range of a half-hour input. That's the standard input to market profile. But that isn't what everyone uses. You can make a higher or low resolution. You can use a 5 minute or a 1 minute or a hourly, whatever you want to do. But just as far as building the display, it takes these letters and builds them, these half hours, and builds letters on them chronologically, and to build something that we call a profile. So that's what you're seeing here is a profile. This is Bitcoin. It's Bitcoin, within a 24-hour period. So you're seeing lots of different letters in the alphabet, uppercase, lowercase, because nowadays markets trade, pretty much 24 hours. So at least a lot of them do. So you're going through the whole alphabet and then some to generate this display. What kind of stands out on the display, or what should stand out, is you're seeing pockets or areas where there's lots of activity, like I'm mousing over, where there's lots of letters across, and then you're seeing areas within the vertical bar, which is a daily profile, where there's a lack of letters, and so that would be a volume void area. We can default say that where there is letters, or where there is horizontal width, there's going to be a preponderance of the volume. So that's a generalization that you can make. It's not always absolute. You can see in this profile, for instance, you probably can't see it, but most of the letters down here are lowercase. So we'll assume that the night session has less time or less volume, pardon me. So there's probably less volume here than you might see up here during the day session. But it's just a generalization that one would can make, I should say. So Early on in the 80s, early 90s, that's when we started developing software was, 1991, and we realized that maybe the approach of looking at a daily market profile wasn't the best. Early on, a lot of the trade was generated on the floor, when Pete, got his membership in the 70s and 80s, but, 80s and 90s and beyond, more of the volume was moving to off the floor. And so we came up with the idea that one should maybe segment data. The original idea was to manually segment it, and then we moved to something which was based upon an algorithm. So we can look at that right here as we're going to look at the same contract, and we're going to move the daily profile to something less than a daily. And by doing that, we are going to, I kind of say it, use the analogy of a television. We're essentially creating more of a high resolution television, so you're going to be able to see things more clearly. So here you see a bunch of what was maybe bigger chunks of data, making now into smaller chunks of data. Yeah, but the principles are still the same. Where you get lots of letters, there's more price acceptance. Where you get less letters, there's less price acceptance. And that's kind of the first iteration of the program that we had, was really trying to move the market from something that was chronological, just a daily, to something which is market time, which is what this is what we call a time variable profile. It has a minimum number of periods, and then it's going to build upon that, and once the volatility comes in, once you achieve that minimum number of periods, it's going to segment. So all we can know within the context of looking at this database, these different segments of data, is that they're all going to have a minimum number of periods, but some are going to have more. And the reason they would have more is because the volatility is contracting. Once the volatility expands, they're going to then kind of segment and start building a whole unit again. And so that's the whole process of market profile, is trying to create a database. The database that we have is what we call organic. You're taking information, generating or creating a database, and then have lots of different overlays that one can use to help generate some type of a trading idea. And I want to do one other thing as far as the display goes. And so we're taking data and making something less as far as the data, daily, I should say. And then we can also go in and aggregate data to make something which is going to give one a longer time frame perspective. So what one does typically in their trading is they're going to, most people are going to have something that's going to give them kind of more of an immediate perspective, a short-term perspective, and then probably have some type of a longer-term perspective. So, what I've done here is I've moved something where before we were segmenting the daily into something less than a daily. And now what I've done is I've done just something the opposite. I've aggregated days together to create something greater than a daily. So, what we have here is we have bigger chunks of data, and so that's going to give us our background. So what we're seeing here is we have these big composite profiles. The same principles. Once again, they overlay everything we look at. Is where there's lots of letters, that's price acceptance. Where there's lack of letters, that's price rejection. So looking at this profile right here, we can see that you have letters here, less letters here, and more letters here. Why are there less letters here? That's because the market was bid up and there was a very, very, very aggressive buying. The fact that we can only see one or two letters throughout this whole range tells us that the buying overwhelmed the selling in a big way. And then finally, once you moved up to this level and you get more letters, that's when the market more became what we call a two time frame market, or that's where the sellers became more involved and were willing to trade against the buyers. So the whole process of shut off the buying, the market has to trade higher, and to shut off the selling, the market has to trade lower. So in this case here, the market traded high enough to kind of shut off the buying, was able to grind higher. But that's the principles behind what our profile is, how it develops, and how we've evolved the whole process of looking at a daily profile to something which is looking at data, creating an organic database, creating a foreground perspective, and then having a background perspective, and then from that we're able to generate some type of a trading idea.
Hey, Stephen, is there any hard, fast rule about integrating the foreground and the background? I've heard people say that when you're considering both the foreground and the background, that you should always default to the background as though the background always wins. Has that been your experience or not?
Yeah, I mean, especially way back when, I think it isn't so much the case now. I think lots of reasons you might attribute it to, back then 20, 30 years ago, the transmission of information was different, right? I mean, now there's social media and everyone has the same information, pretty much immediately, right? Whereas 20, 30 years ago, you might have lose the crop in some part of the world, and it's going to take a number of days before that is realized by people. So I think in general, I'd like to defer to the background. I'm always looking at the background first. I'm going to pull up the screen and try to get a perspective, what is the background? And I'm going to defer to the background initially. But if the market becomes more of a situation where more balanced, like we're going to look at where I'm mousing over right here, we're getting lots of overlapping activity. Why we're getting overlapping activity? Because the sellers and buyers, it's the people are selling up against the tops here and buying against the bottoms here, and then one is going to eventually have to win out. And the point in time that the market moves away from that, someone has shown their hand, or in this case here, obviously, we're seeing the market broke down. The market was very balanced, and the people who are buying are going to either have to give up or they're going to add to their position. But what we've seen, this break in the market from the highs of here $69,000 down to where it's trading down here $57,000. That's short term. That's negative price activity, right? But then if you look at a bigger time frame, we're just going to look at the same information in a bar perspective. I mean, this market rallied from 40,000 up to 69 down to 57. So the price activity is still very, very constructive if you look at it from a very, very long term perspective. So trading is all a function of the time frame you're trading. So if you're a global macro guy, you're looking at this as a buying opportunity. If you're more of a intermediate or shorter term guy, you say a top is in play, you could be trading in the support, but nothing telling me that I shouldn't be continuing to trade it from the background perspective.
Is there a particular tipping point where the background changes or that the foreground overwhelms the background? I don't have the answer to that. I don't know that tipping point other than just from a price perspective. If you keep moving one way long enough, then that would change the background and the foreground, I guess, right? And then the strategies associated with that, like if we're going to be trading the foreground in opposition to the background, the duration of the trades are shorter time framed.
Yeah. Mm-hmm. Yeah. And I mean, I think,
or you would say, don't you say something like that? If you're going to be trading against the background, you have to be active, I think is your word, right?
Yeah. I mean, when we look at a market, when you're on the trading floor, it was an auction, right? So that's what occurred on the trading floor, was an auction. So the locals would trade and the orders would come in and the range would be set, and then the longer term participants would come in and offset that range. If they thought it was cheap, they would buy it, or expensive, they would sell it, or if some news event came in, they would buy high or sell low. But we like to try to really break the market down into what we call the 4 steps of market activity, and that might help answer your question. So we look at this run up here, in the Bitcoin, from, I think this is towards $40,000 up to this first stop is like 67, I think, or something like that. So so this essentially this rally from $40,000 to 67, 65, which is $25,000, in a matter of 929 to 1020. So in less than a month, that's that is a buying imbalance. I mean, everything's relative to how you're looking at it, but if you look at profiles, there'd be lots of overlapping letters and things like that. But you can make the generalization that this push up here, this $25,000 rally is a series of prices in one direction. So that's step one. We call the 4 steps of market activity. So the series of prices in one direction is step one. Step 2 is the stopping and developing. The step 2 is stopping. Step 3 is developing. And so to answer your question, if a market is kind of a hot market, something where the buying is going to be sustainable, you're going to have less development time. In general, the more development time you have in a market, that means there's more price acceptance, and it's more of a two-way trade. So if for me, I'm always trying to go with the trend. I'm always trying to trade against the bottom of the stopping early on in the development of it, because there's potential for it to hold and continue to rally. Whereas it gets kind of late, it's we'll call it a more mature market. This is more of an emerging, and once it starts stopping and developing, it's becoming more of a mature market. The tendency or the probability of it, if it holding and rolling over, becomes great. So the less time a market trades at a price, the more the probability is that it can continue to move in the direction that it's entered that sideways development range from. And so one could actually, look at it and really break it down. And I'm sure if you built a big composite profile, and you could, we used to do that in the past. We don't do that anymore per se, just because it's more of a manual process. But there's a certain amount of time that, if you get sideways overlapping letters, if you get lesser overlapping letters, I think it was 30 or less at a point of control of this big development, and it starts moving away from there, it's going to have an ability to work higher. Whereas if it's more mature and you get 40 to 50, the ability for the market to move higher, it becomes less. The development area almost acts like more of a magnet.
As though if you've given people a chance to get on board.
Yeah. Yes, exactly. So I mean, the more time, the more opportunity for a person to get involved, or people to get involved in the market, the less likelihood for it to continue, right? So,
right.
If the market's pushing higher and everybody sets back and everyone gets a chance to get in, then that's the likelihood of the market continuing to become small. If the market doesn't really ever set back, then probability of it working higher, becomes much greater, just for lots of reasons. End users or producers needing to do something, and they need to have their control or put their risk on, and it's don't get a chance to do it, and they've got to pay up. So that's kind of the whole idea behind shortened development time versus the lengthened development time.
Right. Okay, can you recap the 4 stages again, so I can just remember them?
Yes, I mean, let me throw this up here up to a different screen, and I can kind of draw on it a little bit.
Thank you.
I'm just going to make so the step 1 would be a series of prices in one direction. So here we're just having this big push up here, like I said, from 40 to whatever was $65,000, and this screen is just really doing nothing more than taking profiles and just kind of giving one a perspective of if they're aggressively building pairs of profiles, or more passively building them. And so one with the trend, you're getting all these blue pluses actually, but all these blue little hash marks that just kind of tells you that it's kind of really unabated buying, very, very aggressive activity. And then you get all these triangles, which just kind of tell me the market's moved from a trend which is up to kind of more stopping. So that's the series of prices in one direction is step 1, and then the stopping at a price or prices is step 2, and then developing around that stopping is step 3, and then the market's going to do one of 2 things. It's going to attempt to move this stopping development, which would be we'll say a first standard deviation, right, a value area. It's going to try to shift this thing back down and create more of a visual 313, or it's going to roll it back up, and this what is now visually looks like something like this, a 3-2-1, an asymmetrical bell curve, right?
Right.
It's gonna either roll this thing back down like this and make maybe the value area more fall in this type of a range, or this could be the value area, and so price is going to have to round up to the upside. So for me, I'm always just trying to take any chart I'm looking at and trying to, that's always the first thing I look at. So
that's super interesting. In other words, you're combining all the move from 40 to 69 almost as one profile, and choosing to view it the corresponding how that resolves,
right,
as the background.
Right. And here's, I mean, to your question about development time, so this is the same thing. We'll say if you can kind of visualize this as kind of a balanced 3-1-3 bell curve, and so there's a tendency for the market to move out of that. So all this move down from here to here is a series of prices down, and then it stops and develops. And so you can see if, early on, if you're trying to trade against the two, it kind of pays off, right? So the high of this development area is, let's say 38,000, and down here it's $28,000. But then this is the two. This is what I want to be trading against. If you think, this is the impetus pushing lower early on, you want to be going with the trend. You want to be getting involved against the two as far as trying to trade it from the short side. You could also take it one step further. This could be another 3, 2, 1 down. The same thing, going to be trading against the two of the upside. But then
most people are not going to be understanding 313 or 321.
Okay.
So I would suggest that we just say that a 313 is a barbell distribution. Is that right?
Yep. I mean, a 313 is kind of a I would just say we like to use the terminology in uppercase D, I would say. So this would be
okay.
From your stats classes, kind of looks like a Gaussian distribution, a normalized bell curve. So that's the whole idea of a 313 is you got the third standard deviation, the second, the first, the second, and then the third. So you get the majority of the volume activity in the middle, and you get the less activity at the two extremes. So that's kind of a symmetrical bell curve. As you said, we get a 3, 2, 1 up. So you get a situation where you get one more skewed towards the top. So that would be a 3.
So in that kind of distribution, the one you're drawing now, that would be, you would use that as the beginning of potentially a vertical move from a balance period.
Yeah, that is the beginning, right? The series of prices in one direction, that's gonna if this unfolds as this, that's going to be the series of prices in one direction, right?
Right. And so if someone sees a profile that has where we've had a series of normal distributions, in other words, it looks like it's just a normal sideways bell curve, and then they start to see this formation, that would be the key, that there has been an imbalance present, and that we would expect the market to continue in that direction, right?
Yeah, that's the start of it, right? I mean, we're always dealing with markets of uncertainty. We never know anything about what's going to happen tomorrow, but we can for sure say the footprint is there. So you can see the footprint of down, stop, develop, when then this area, the two, we'll call it, right?
Right.
You always want to be trading against the two because you've got some imbalance in your favor. You got the balance, the sideways. You always want to be, sell high in imbalance, right? And buy low imbalance. That's the trading approach. But if you got the background in some negative price activity, you can forget about the buy. You want to go with the direction, so you want to be selling it the first early on in the push down against the two.
Did Pete ever have any successful or favorite setups that he used, and did he ever trade with stops?
Early on, obviously way back when he started trading, there wasn't the volatility that we have today. And he always believed that one would be able to exit a trade, better as far as, and he was on the trading floor. You can't forget that. So he was always right in there in the heat of the moment and seeing what's going on in the pit and picking up the information of what the traders were doing. So he was had, being close to the pit and have that immediate access is always a plus. But his philosophy early on, was not to use a stop, but in the last 10 years, actually, his whole philosophy has evolved, and part of that has to do, I'm sure, with two things: being off the floor, number one, and just the volatility. So, I think in most cases, if barring some, huge global economic, geopolitical event, one would probably be able to get out of the trade better manually versus using a stop. But it's just for purposes of risk controls and people freezing right in the heat of the moment, when the world's falling apart, it's hard to do the right thing. So now he is an advocate of using stops.
Many years ago, he said that the market was actually the electronic trading was not going to be able to provide the liquidity at the time that people needed to exit a position, which was going to cause larger vertical ranges.
Yeah, and that in conjunction with the 24-hour markets, right? I mean, people seem to feel comfort in being able to access the market, around the clock. But as you said, here in the States, you look at the grain, the amount of volume traded in the grains, we'll say from the night session until 4 or 5 in the morning. It's literally 10% of what you're going to see for the day session. So I think that's a factual statement. If you have to get out of a big position, it's not going to be the opportunity to get out of it. But for the small traders, it's probably not. It's going to be an advantage. But for the big guys, it's really not going to give them any better exit, I wouldn't think.
And the reason that we're getting such larger vertical ranges is that it takes time to replace the supply. It's just not always available at the time that you need it, especially if you're wrong.
Yeah, and that in conjunction with that much more money out there sloshing around, right? And then I think that you see a lot more opportunists, right? And that's how I would perceive myself. I mean, you can see, I look at all these different markets I trade, 40 or 50, different markets actively, and so I call myself a jack of all trade, but a master of none. So I mean, some people focus on one market or two markets. We're more proponents of trading opportunities. So I think if you understand, the big benefit, one of the big benefits of market profile is that it works with anything that one would want to chart. You're building a database, right? So I think if you can access, all the crypto, all the shit coins as they call them, all the cash FX, all the futures and fixed income stuff that we're involved with. If you're able to build a database on that, if you have access to the volume, that's a big plus. So I think that if you can understand or have access, and that's the nice thing about today, with access to all the different exchanges and the online volume and the ability to write to the APIs, if one can really kind of build a good database of markets, and if someone understands how to write scripts and build algorithms, and there's lots of things that one can do to help you alert you to maybe a market that is in a position to do something. The scanning capabilities, as opposed to just watching the one market tick up and down all day. There's lots to be said for a person who becomes an expert in anything in life, right? But
I mean, human beings are generally considered generalists, and insects are considered specialists. And so, I mean, from an anthropological perspective, so the idea is as a person who's just getting used to the idea of, in other words, since we have to sleep and you get up in the morning and you can look at the profile and you can see the behavior of prices, and or in that case, the mentality or the expectations of people who are spending money predicated on the shape of the profile, right? So it allows you to sort of become in step with that organic process that you weren't able to observe, for example, in person because we were sleeping, right?
Right.
And then
you get questions. I mean, you always get questions, as far as day. I mean, just to your question as far as sleeping and waking up. I mean, you can't discount the fact that something happened when you're awake, so you don't want to just ignore that. But it's, you want to integrate that into what you're looking at, and so we'll say you have the market looks positive, and you've got a position going, and the market spikes up at night and then fails. So maybe your perspective of what was something which was positive in the market, now with the fact that you had some type of an excess in the market or some type of confirmation that the market traded to a price too high to shut off the buying, maybe your perspective should now change.
Got it. And then the is the concept of tails versus so we say a sort of a double or triple bottom. In other words, the market's looking for certainty to close off a direction, or just looking for certainty. So if the price of something is too high, the market will move away from there very quickly and not return. As well as correspondingly, if the price is too low, the market will move away from there quickly and not return there. And so the inferred corollary would be that if that you wouldn't want to lean against a double or a triple bottom because there's no certainty there.
Right. Yeah. I mean, and you'll see that in markets. I mean, I think, what we like to use the expression, looking or trying to understand the prices a market uses versus the prices the market trades. So let me see if I can look at all these different markets.
Can you say that again? I'm sorry. The
Yeah, I
view
think
that.
what we like to how we like to view the market is one wants to really try to understand, the prices the market uses versus the prices the market trades. So, here's natural gas, for instance, and we can look at the market breaking down here, and that would be something negative. And so, if we're going to look at this as some type of a 3-2-1 down, in the context of just this is a starting point, and you get your 2 and your 1, you're trading sideways, and the market's trying to trade back up and shift this whole first standard deviation up to a higher price. We can see this one single push higher, right? During this, and you have, it's probably 2 or maybe 3 letters across for an hour and a half, and we don't know how much time it traded there, but what we would be looking at is trying to understand in the context of, from this point forward, this whole range of prices, from here would be a price excess, so the market traded higher. Why did it trade higher? Because it was buying. Why was it buying? Because people wanted to be long, or people wanted to recover shorts. But as you mentioned, the market reversed hard from here. So, I'm trading this from the short side. I would be looking at this thing or I would be saying that, from this price here, and then from this market trading all the way down to toward this price here, which is where you start getting letters again. That's a big price excess. That's where people bought the market and it didn't work out. So people are going to see that as a level to sell again. So you're going to be seeing resting offers all the way through this zone. You don't need to put your offer up against the high, but you're going to see the market's failed here, and the degree that the market's going to retrace into this range is going to kind of give you kind of an underlying perspective as to how how strong or how weak the market is, right? If it's more strong, it's going to retrace a lot of this. If it's less strong, it's going to have a shallow retracement.
Right,
So
like almost the opposite in stocks, where you're seeing very shallow retracements, and the market continue to grind higher, and so in any case, for example, today in the stock market, right, where they broke down hard, but then immediately reversed and did not give the people who were either sellers or shorts on the way up any chance to cover until, way near new highs. And the understanding is that you can use the shape of the profile or the tail of the profile to see that the strength of the buying in this case in stocks, or in that case the strength of the selling in natural gas.
Right. Yeah.
And then go ahead. No, go ahead.
I mean, to your reference of the S&P, I mean, this is an S&P chart, and the one thing that you might notice a little bit different here is you're going to see lots of black letters, which you've seen before, but you see a sprinkling of red letters, and there's actually always 4. So, talking about profiling and volume profile, and what our perspective, or what our using our terminology of the volume profile is different than what I think what the general consensus is out there in the trading world. And most people look at volume profile, and they're looking at at volume of price. So in this profile here, you're going to see lots of this was having a volume histogram over here somewhere. You'd see lots of volume here and less volume at the extreme. Whereas what we evolved to, in 2001, I think we started looking at volume at times. So what you can see here, what we always like to reference is where the 4 heaviest half-hour volume periods. So we're, obviously I can look at all the online volume information you can get. We're able to see here's the half-hour ranges, and here's the volume, that we're seeing within those half-hour ranges. So
how would you use that?
Like you remember back in the day, when they would ring the bell, right? Fast market conditions, and you wouldn't be held for trades, and on the CQG machine, the high beam would come on. So that's just kind of a very, 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 very unusual situation, where there's all kinds of activity coming in the pit, and so we always like to think that heavy volume, which is why they would not hold traders, because it was unreasonable to hold someone to a trade. So we view a heavy volume as potential excess in the market. So I'm always looking for, when I see heavy volume, red letters, if it's at a market extreme, I'm always willing to try to fade that, thinking the market's going to kind of hold and suck back up. Stoudemire used to say all the king's horses and all the king's men. That's kind of where they were all in on something. And if the last seller is sold, the last buyer is bought, it's not going to work lower. It's not going to work higher. So
Pete would always say stuff like the biggest, fastest move usually has more going for it, right? And then,
yeah.
of course, all the king's horses and all the king's men. He would also say that the market's trying to close off a direction.
Oh yeah, I mean, for my trading, I always like to try to eliminate. I'm always trading just one side of the market. You got some type of a perspective that's going to give you an idea, whether it be long or it be short.
What would be something that signified a direction being closed off?
Well, like if you see some type of an excess, like less prints, right, where there's lack of trade. So down in here, where the market comes down and you get heavy volume and you get heavy volume again, and then you have less prints. So for me, obviously you don't know it till after the fact, but as the market sucks back up, you can say that this can be an excess, and you'll be trying to buy against where that excess is in place.
And you can see they did. That's at 46.40, where they sat there just for, I couldn't figure out why, but so a tail, if you're looking at a profile, a tail could be a significant direction.
Shut off, right?
A shut off, right? Thank you.
Yeah. That tail could be, it's all relative, so some markets are more chunky if there's not a lot of volatility. I'm sure I don't look at Eurodollars, but I'm less volatility Eurodollars, right? So maybe you see a 4-tick, across horizontally, maybe that could serve as an excess, where you see something like a Bitcoin or a NASDAQ or whatever, you might see 1 or 2 is more likely. But just getting back to this example here, I mean, if we're looking at this type of move, from here up to here, this is a balance area, right? Right in here, and the market moves higher, continues to move higher. So this area is starting and all this space right here. Why is there's a space here? Because there's lots of buying in the marketplace and buying over one of the selling. So buying into that is a good trade. So it traded down to here and fell and filled and came back up, and that's fine. But then it was negated. So now the next thing to look at is, for me, I'm looking at this push here. And so, from this fat point up into here, from here over and up into here, that's going to be some type of a minus development area that one can try to trade against as well. So for me,
just hold on. If you're going to trade in a minus development area, your strategy would be different than it would be to trade in a sort of a fat spot in the
I mean,
right.
I mean,
if you're wrong in the minus development, it's not coming back, right? So that you take your step and then you have a stop.
One would say that I kind of stay away from trading in a fat area, kind of where there's price control.
Because everybody's involved, right? It's where you would exit a trade into a fat area, or is that from the days of the ring?
No, there's still merit in that. There's obviously merit in that as far as why is it a fat area? Because at one point in time it was price acceptance, and for me, if it hasn't tested that area again, I'm more inclined to say that I'm going to lean against that the first time. So that's the whole idea of looking at this, from here, this D period here, if you just kind of understand that that's the fat part, and markets have a tendency to work out of the fat parts. So I'm going to say that that's going to be the bottom of the minus development area.
And then look at it as, in fact, it is. It functions as a
kind of a launch point, right? And so trading into that is what one needs to do. And so the difficult thing is where do you looking at this from a price standpoint, it looks like it's 46.54 to 46.70. So where do I enter? If the market is real strong, you want to be entering more in the upper end of the range. If it's less strong, more in the middle. But all I'm trying to point out is that this minus development area, or this volume void area, is kind of the pocket you want to be trying to trade against. And when you can confirm that with the volume, like you can see here, the market held that pretty well. And then I'm just updating this now, and you should see it add more data in a minute here.
So if you're initiating into a minus development area, you know that you better be right. So you better have much more discipline. If you're going to trade in an area with high acceptance or the wide spot of a profile,
Right.
you know that if you're wrong, you'll probably get a chance to get them back, because it seems to be a price acceptance area.
Yeah,
right?
I mean, markets are going to move one of 5 ways, right? They're going to move sharply up, sharply down, a little bit up, a little bit down, or sideways. So, whatever you're doing in this scenario, you're going to be able to get a small a small loss, but the risk reward, ratio. I'm always trying to find situations where I can do 3 to 1 or 5 to 1 or 10 to 1 or 21 as far as my upside versus my risk. That way I don't have to grind it out. I can be wrong 2 times out of 3 and scratch, and that's if I'm just a 3 to 1, right? But I'm quite often find scenarios where it might be 5 or 10 to 1. So you get a couple winners and 5 or 10 losers, and you're still doing well. So that's
the process then in the search for those long odds trades would be looking for the market to trade into a minus development and also closing off a direction.
Yeah, and then by default, a minus development is a shut off direction, right?
Okay.
Right, because whether it's this is an area where the sellers failed, and this scenario where the sellers failed. This is something where the market's moved up and coming back into it. This is where the market pushed down and you're coming back into it. But in both cases, you trade it the same way. You're looking for the lack of activity to hold to a degree, and continue to work in the direction that you initiated the trade from.
Okay, so we bought the dip this morning, say predicated on that minus development area, and the background of the market is in fact moving higher. Now, as the trade unfolds, are we looking for a measure of speed through time, or are we measuring acceptance of relative to prior areas of acceptance, or are we integrating gut feel, or is it, trees don't grow to the sky? At what point, how do we measure where we are in a trade? Or is it a constant evolving thing where you're just, as the trade unfolds, you say to yourself, maybe there's more to this, or maybe this is all I got?
Yeah, that's how we like to view it. You never want to shut off an opportunity, right? So when you're on the floor and you're just trying to make 2 ticks, you never made more than 2 ticks, right? Because you shut off the possibility, right? So you always want to be dynamic in your analysis. It's like I said, for me, I'm not trading 1 for 1. I'm not risking $1 to make $1. I've never approached them from that perspective. So I always like to look at the best case scenario. Where can the market trade to? It's at all-time highs. If it makes a new contract higher, all-time high, where is it going to stop? There's nothing for it to stop against, right? So it could melt up as you talk about, or it could fail at the highs or marginally above the highs and come back down. But it's going to be more a function of trading the price action as opposed to having some predisposed price, especially when you're at a level where the market hasn't traded. Coming back into the way the market traded, looking at this price action, they have a big run up, and is that all? And we're at all-time highs, and looking at it 2 ways, I guess, right? They're all-time highs, and the market, whatever this high was, 47.11 down to 46.20. So you broke all of 90 points, from all-time highs, and here the market is back up against all-time highs. So that's really constructive price action. So you wouldn't want to, at least from my standpoint, I've been going to some of listening on a couple of those Bitcoin chat rooms and things like that, and they talk about orange pilling and diamond hands and this and that, and making you think like you're going to miss the trade of a lifetime. And who knows? That's the nice thing about all the different markets, the way they're moving today is, if you miss one, there's something else out there. You don't have to be worried about that. But I would say that based upon what's going on in the marketplace today, with this market, for sure, you want to be erring on the side of trying to overstay, just because it seems like everyone has tried to play it from the short side, and that hasn't worked, and maybe there's a lot of money on the sidelines and things like that. But just the whole dynamic, and I think just the mentality of what's going on in the marketplace today is, it's going to try to, what the government's doing and everything else is going to try to expand the range higher. And you want to, if you have an advantage where you're entered the market at, and they're willing to give that back, for a 3x or a 4x or 5x of where you're at right now, this is a good place to do it at.
One of the things that we might want to talk about is that the process of going vertical and then becoming in balance, and the price, the strategy, the personal, how we would execute in that situation. In other words, do we think that this is still valid? Where the market goes vertical, you're forced to buy high and sell higher, right? And then as the market starts to get balanced again, where we look to fade the ranges around the market as it gets balanced. In other words, we switch from buying high to selling high. And then as the market gets balanced, we look for the breakout. I remember you said that only like 10% of the moves or time that the breakouts work, right? And so the reversion, the reversion to the mean trade is actually the more grinded out, but has a higher percentage of working. And in your case, you're like a big game hunter looking for the breakouts that stick.
Right.
And so is there a particular best time or best place? And we should help people understand that there are times, right, that breakouts don't happen every day, right? There's a time required for the market to get balanced before it can break out again.
Right, and it's also the time frame you trade also, right? I mean, if you look at all the CTAs of the world, I mean, there's hundreds, there's thousands of CTAs in the world. And if you look at those aggregators who rank them and show their performance and things like that, I mean, I think a lot of my friends have some of these trend following CTAs, and we'll say prior to the last 2 years, I would say the previous 10 years, they've all had terrible returns or lost money. And in the last 2 years, they've kind of knocked the cover off the ball. So I think part of it could be the function of the environment too.
Oh, right. That Taleb talks about that in Fooled by Randomness, how some people's biases allow them to outperform in certain, macro fundamental market environments.
Right.
And then, of course, they fail to adjust when things change.
Right. And to your question, I think a breakout is a function of the time frame you're trading, right? So if I look at a 1 minute bar or a 30-minute bar or whatever I'm looking at, so it's going to all be different, and so I think, for instance, you look at the that's why we segment data. If you look at the crude market, I think in 08, I think the crude put in the high of $140 a barrel, and
142.
142. Okay.
How do I know?
Yeah. Last year you had that goofy trade to a -40, so there's a $180 range in crude, and so if you're a big global macro guy, you're looking at the extremes and trying to trade, and obviously there's no opportunity to put those prices on again in our lifetime. I would guess, maybe I'm mistaken, but so you really got to drill down and look at a shorter time frame, and so what the time frame you're looking at is going to be more determinant as to whether you're going to see the market in a, is it breaking out or not breaking out? I mean,
so it's predicated on the time frame that you're trading.
Yeah. So
but do the same principles apply across all time frames?
Oh yeah. I mean, I would say so. Like within the software, we look, as I said, the default is all half hour inputs, but we have the ability to change the resolution. So I could look at a 5-minute database.
Yeah, I get it. So if a person who's traded a 1 minute screen their whole life can look at a daily chart and say, I know this pattern, but they just now have to, instead of letting a trade take 20 minutes, it's going to take 3 weeks or a month to do that, right? That's an interesting point, is though the principles, the flea of the flea, right, on the dog, that fractality is actually a valid measure of, I guess you could say, auction market theory or market behavior, right? What would you call the knowledge that is the reading of profile?
I mean, I'd say it's you understanding how an auction works. I mean, that's the most important thing. And so I think that, an auction is it's in all markets, right? Like I said, whether you're looking at the cryptocurrencies or the FX. I mean, talking about profile. I mean, in the early '80s, when it first came out, all the FX dealers, the fixed income, all the market makers would love to have it on their trading desk just because it gave them a perspective as to, how they should mark their whatever their book was. And so I think that, things have changed, obviously, as far as how we view the market from, more how fast it moves. We used to
Right.
see a lot more balanced days like this, way
Yeah.
back than we do today. But, the whole idea of how an auction works, that's transcends time and market. So I think any, if you, and I mean, just, why have we evolved software? Because, you've got to, you have to reinvent yourself and be dynamic in whatever you're working with to keep it, current and keep it as good as you can make it. But, I think the general principles, just like anything, right? You're a big skier, and then, I mean, you can teach someone how to ski, and, with the new technology and skis and the way the snow is and things like that, you have to modify your program a little bit. But, the whole idea of
Going
making
downhill on skis hasn't
progress.
really, it honestly hasn't changed much
Yeah,
since the wood skis.
yeah.
Obviously we're skiing faster. Um, is there a connection to volume profile, or is that a completely separate animal?
I mean, what we call volume profile, which is, within the context of our program, like I said, we're seeing, I can look at any volume, because everything's, electronic now. We can see all the volumes that are occurring in half hours, right?
Right, sure. And like CQG, of course, like a CQG volume profile that is an an underlay, so to speak, or it sits off on one side of a bar chart.
Yeah.
And
So they're looking at volume at a price, right? So
yep.
and then, if I changes to a 1-tick scale, and then you can see, you have a histogram, with the volume, just sitting out here, and you can aggregate it. I don't honestly use it, but it's night and day as far as the way our volume profile works versus the way that the industry standard is. So
Yeah, I understand, but most people get volume profile for free. So the understanding is of minus development in a traditional free
yeah,
version of volume profile would
yeah.
be a
I mean,
place that you could initiate into versus,
oh
and
yeah.
then look for the wide spot as a place to exit or price
Mhm.
acceptances. And flip side, like if the market were to hold one side of that, that would be the springboard for a vertical move.
Yeah, yeah. So, I mean, for me, a volume profile is the same as a profile. I mean, in my eyes, I mean, they're, I've read a little bit about, we'll call it the footprint, and I forgot the name of that one group out of Chicago that, was one of the first to put that out. But I can understand the merit of trying to understand, the volume if they're lifting the bids or hitting the offers, and where you're seeing volume like that occurring, and, people get stuck. I mean, that's the one thing that I would tell people to look at is if you can initiate all your trades when people are off sides, that's where you're going to make the most money, because
Yeah, that's because there should be no retracement from there, right? If
yeah.
someone's wrong, for
Mhm.
example, the people who sold the lows today never saw
Mhm.
the light of day.
Yep. And so they're stuck, and then people see the rallies a little bit, then people buy it. They see an extreme, and so you got the sellers who are still short, anxious, and got to cover, and then the buyers just keep it elevating, and they're buying more. So yeah, that's the one thing. The two most important things I would say on trading is being able to know when to vary your volume. When you put on a bigger position versus a smaller position, and knowing, how the market is positioned and when people are stuck. If you can do that, then I would say that you're going to be able to make money, and probably good
So
money.
right, the idea is to have less on when you're wrong and more on when you're right,
Mm-hmm. Mm-hmm.
right?
And yeah.
And
Mm-hmm.
so is the theory there is to average, or is it to add, or is it to just start with a big slug?
I mean, I've never, and, Pete, to a degree, I think, we're gonna have an idea on, I can't pick the exact price, right? I mean,
Yeah, no can I, right? Nobody can.
yeah, look, what I gave you here is, 46.54 to 46.70. So that's 16 points. So I'm giving you a range of 16 points to enter a trade. And so that's just the start of the whole thought process. You want to be
Right.
long in that range. And as it trades down there, you have to do what you need to do to kind of find a price to trade at. But for me, when I always kind of back into it, I'm willing to risk X number of dollars per contract. And, we'll say that in this case here, I'm 70, is the price, then I've got to risk 16 points. So what is that, $800 a contract, right? So
Yeah.
do I want to risk $800 a contract? And if I do, jump in, and if I don't, then I'm not going to do it. So the ideal situation is when you find a situation where you have a decent payoff, where you have minimum risk. So if I could see a 2-point window, $100 a contract, I could trade 100 contracts and risk $10,000. And if the market rallies 100 points, I make 50.
Yep.
50,
Right. So varying the volume, finding people off sides, understanding the background versus the foreground, using minus development in as sort of the lay of the land.
Yeah, it's kind of that's your the area where you've got something that's defined. This anywhere you see minus development, in this pocket here, there's a buying situation, and in this pocket here there was a buying situation, in this pocket here there was a selling situation, so
what's the shelf life of minus development? At what point is it no longer relevant? Like how many days back?
For me, I'd like to say as long as it hasn't been tested, as long as it's intact, and hasn't been tested, for me it's valid. So here's an example right here. I mean,
okay, so right, it doesn't go stale.
Yeah, for me, I always believe that, and it seems to work pretty well. That's what I do all the time.
Yeah, look at that. I mean, it worked perfectly out of that break. And again, I guess into today's, it's 5 o'clock, which we've been on for an hour. Thank everybody for watching.
You want to look? Charlie said, "Look, are there any questions that need to be addressed right now? Do you want to look that quick? And if there are, we can answer them. Otherwise, we can call it a day."
Let's see. Let's see. Mine's kind of frozen. Do you want to look through the chat?
Let me look here. I see Q&A.
And if anybody has a question, Steven's email is simple. It's hawk0101 at Hotmail.
Yeah, I've got a couple here. I'll put this sheet up for us. So if people have any questions, they can feel free to email me or you.
Obviously the money question, of course, for today is what's going to happen tomorrow.
and yes.
Yeah, you would have to assume that. What is tomorrow? Friday?
Yeah, the last day of the week.
So right, it's expiration. It's also the week before Thanksgiving. We know that it's important that everybody has a good Thanksgiving from the Fed's perspective. Also, the Fed chairman's up for reappointment. I mean, the way they've been smashing the vol, given today's tail, you would expect today was a good test of the low. If anything, you would get a range day with a test of the highs tomorrow.
Yeah, I mean, I think that the way that the market recovered, and why did the market break? I mean, there's got to be news. I don't honestly follow news too much. But there has to be justification, for the risk off across the board, right? You saw the crypto stuff, you saw the grains, the energies, the metals. I mean, everything was hit, and some came back and others didn't. Obviously, indexes came back better than anything else.
Do you have anything that you're watching? What positions do you have? Do you have any?
Yeah, I've got some grains positions going. I've been long the wheat for a while. I bought the stocks on the break, and I've been trying to play the crude oil from the short side.
Yeah, from that 84 area, looks like it ran out of gas, huh?
Yeah. I mean, that's the way it looks right now, and it seems like it's retraced a bit. And I mean, the question is how low can it trade? And once again, the market's rallied from $40 to $80, and in the throngs of a pandemic and a slowing global economy and everything else. And obviously we shut off our production here, so there's things to there's one guy on the John Stafford at the SIBO used to say, what's more important than what does happen is what doesn't. So I think,
Say that again. Say that again. What
what's more
doesn't happen?
important, what's more important than what does happen is what doesn't. So with all the headwinds in the energy markets, right? And still you're at $80, that's pretty good price action. So, I'm inclined to think that even though I'm short, the market could continue to rise. Same thing with all these risks on things right now, I guess, until we see something like a big market failure, across the board, you got to go with the potential for the markets to move higher.
Yeah. Someone says, do we need Capflow32 for doing this? And the answer is no.
Yeah,
There's many other CQG and many other platforms that have market profile. Someone says, Stephen, thank you for this. When you are trading ranges, when in balance, example, you sell the top of balance. If the price reverses and the price continues then and pops through the balance top, in that case, do you reverse? Personally, I have a hard time reversing.
right. Yeah, that's the hardest thing to do is.
Right. This person wants to know if you reverse.
No, I'm as with you, I kind of more lick my wounds and move on to something else, right? You got like that's especially when if you're looking at, they've looked lots of different markets. You're not so vested in something, right? So you put a trade on and it didn't work. And like Pete always says, you want to have a casual indifference towards whatever you're doing, right? So you put
isn't that great?
Yeah, it's a loser, and you don't take it personally. You want to move on and do something different, and whether you look at a different market or whatever it might be. But if I'm like I said, if I'm always trying to eliminate one side, as you said, I'm probably less inclined to trade out developing market. But if I'm doing one trade, I'm not going to lose money on that one, then go the other way and lose money on that one.
Yeah, that's been my experience. You end up dog chasing its tail.
Right.
Or I'm not that good, I guess I could say. Someone wants to know, how do you measure the potentials for trends or balancing in the market? And we could say that the market goes from vertical to horizontal and returns to vertical. Just because it's going horizontal doesn't mean it has to go vertical. It can continue to go horizontal. But the potentiality for vertical increases as more time spent, as you become more balanced. And Pete used to tell the story of the lumberyard, where he would say that in the old days, you would keep inventory. And as we went to just-in-time, keep inventory in the lumberyard. And as we went to just-in-time inventory at the beginning of the internet, that forced people to the marketplace. The guy would come in and the builder would say, I need enough lumber to build a condo complex. The guy would literally call the market, causing a vertical rally. Once he was finished, he was gone. And the market then resumed its horizontal action. Right. And so the whole auction market theory and the processes that go with it are based on what's really happening in the economy. And what we saw in the ring, it's not a secret sauce. And so it's easy for you to explain this to other people so that you, and when you see it actually in the real world and you can see it translate into the way prices move and markets behave, it allows you to act with confidence and know where you are in regards to the cycle. That would be, how do you measure the potential for trends or balancing in the market? Is there a particular tool that measures, where we've gone sideways long enough, or you can see it?
Yeah, I think, if you had the ability, like one version of software we have, you have the ability to kind of aggregate a big chunk of data and kind of get what is the point of control, the widest TPO point in that whole data mass, and define where it is and see the number of letters across and things like that. And once you get a certain amount of development, the market's more ripe for vertical move. And it's specific to a market too, like
great term, by the way. It's ripe. It's ripe for a vertical move. On a more simple way to measure the balance, after 9/11, when the trade centers came down, we had to create stuff out of nothing in our new warehouse location in Long Island City. I just lopped together a 65 and a 33 period moving average on a 30-minute chart, which is a lot of the premise of the profiles that we use in Capflow. And it works very well. So if you're looking to do it just to see it, use a 65, 33, exponential moving average on a 30-minute chart. And when the lines come together, it's not a crossover system. It's when the lines come together, it demonstrates, and many moving average systems do this, Bollinger Bands, when they come together, essentially you're saying that the market's balanced and ready to go vertical to know where you are in that cycle. That's the answer, Mr. Kevin Bruce.
Okay.
Question. Thank you, Stephen.
Okay. Okay.
I mean, do you think there's anything you need to tell everybody who's trying to figure out where market profile is these days? Well,
No,
what's
I mean,
different
I
now?
think what I put up here, if you can see on the screen, you can see resources, right?
Mm-hmm.
So that, yeah, the first document, is the board to trade document on market profile. It's like 365 page manual that kind of really goes over the nuts and bolts of the legacy market profile. And a lot of this stuff is still relevant. Some of it is not, but you gotta read the whole thing. And the second document is my book, and that's more current. So it really addresses the ideas of the time variable profile and some of the things we've discussed today as far as trading at different setups. And I think the one thing that Pete always says, and obviously you've been doing this a long time and you can attest to it, that you got to kind of reinvent yourself. And so I think the way that you traded in the 80s or 90s or 2000 or 10 or 20, it's similar, but it's different. And I think that we'll continue to evolve the way we approach markets and with the profile, and we've done that for the software, and we'll continue to do that. But I think the most important the thing that I do every day is just as I said before, is I'm just calling up a bar chart on the software. It's not much different than what you're going to look on your CQG or whatever you're looking at, and just really trying to understand what are the 4 steps. I mean, first look at the ES here. I mean, just getting a whole perspective of minus development. I mean, even though these are these bigger chunks of data, every bar is 6, 7, 8 hours, but you get these quick spikes down and no development. I mean, nothing could be more clear than that, right? Then you get the two-sided trade here, and you're getting another push higher, and you get the break here, and then you're getting a bigger vertical move, short development time, even short development time here today. So there's nothing really that would make one want to be selling this, that's for sure.
So allowing people to see that the shorter development time or minus development is one thing that a profile allows you to see that a bar chart doesn't necessarily allow you to see, right?
Yeah, I mean, it's like I call a profile like it's an extra dimension. It's kind of like a three-dimensional versus one-dimensional, just the bar. So I think the profile adds horizontal depth to a vertical bar, and the chart that you're looking at here. I mean, understanding these are all profiles, and so every profile is 12 periods at least. So I mean, they're not all these single bars or single letters, but you're getting degrees of pushing down and coming back up, and so you get more clarity if you see that within a profile. Like this would just be a bar, but you're going to get an idea from that bar where to put a trade on. So we'll say that you see this thing here pushing up here. You're trying to buy it somewhere between here and up in here somewhere, and for whatever reason you miss it. So fine, you missed it to see the market's trading up here. So on this bar here, you can see this is the bottom of the developing area of this profile. So you're getting few letters below this, so you're buying against this. So maybe you wouldn't be able to see that with a bar chart, but you can see that with profiles. That's a benefit.
Yep, got it. In other words, it's another perspective, I guess. Well, we're kind of all over the place tonight in this conversation, and if someone's just getting going, how long do they think they need to get a feel? How long before they get a feel for this, do you think? A year?
Well,
6 months?
To get a feel for it, I mean, I would say that, I guess that's a function of how much time you're spending today, right?
True, right? Yeah.
If you're actively doing it and looking at a screen all day long, I mean, you're trying to trade, you're spending time understanding or learning, reading on what is a methodology, then you're getting some means by which to view what a profile is, and just kind of seeing the market develop. I call it, it's kind of like it's a puzzle, right? So you're understanding how all these puzzle pieces fit together. But I would say you want to try to not try to figure everything out, but just try to look for one thing. And so the ideal thing to do would be try to look for maybe an excess, like you're looking at this in the minds development. If you can look at 20 different markets, I mean, the more markets you look at, you're going to be able to accelerate your learning process because you're going to see a bigger sample size of opportunities. And, you're going to get confirmation of what's going to give you confidence. You're going to see it through your sample size of observations that it works. Nothing works all the time, but if you get something skewed to your favor and you can see that it works, you can add that to repertoire of potentially trades and other things over time. But I would say that if one spends half the day or half of a trading day behind a screen and looks at a profile for 6 months, then spend some time doing some reading, over the weekend or whatever, getting through the books and educational stuff. For sure, you can get fluent in it in 6 months, and then it's where do you want to take it? I mean, there's things I'm trying to work with AI and neural networks and machine learning and different things like that. And if you're proficient in any of those fields, then maybe you can take some of your understanding of these principles and apply that. And I think that would be a good situation for people, because I don't really think there is anyone approaching this market from that perspective. And
yeah, I think you're right. I think you're really onto something there, because the principles behind the profile are just an organic representation of what's happening. It's not laying a trend line or anything on top of it, and it's not time-based per se.
Right.
So look, we've talked way too long. People are going to be bored, but thank you very much. It's really, there's a huge demand to know this stuff, and
we'll work on see if we can have maybe things in the future, setting up something. When goes or something, we could discuss opportunities like that or situations like that if warranted.
Yeah, I think so. And 10 million new Robinhood accounts every 3 months. So get out in front of those people. I mean, people who are listening, get out in front of those people, because
and we can orange pill all of them, right? And get I guess the whole thing a broker wants, or learning from wants, is they want to keep the account whole, right? So you can keep people. First step is keep people from blowing up or losing money, and then they can that's their tuition, right? If they don't have to spend money on tuition as far as losing money, they can spend money on education, keep the account neutral or whatever, but not blow it up. And then with an understanding and knowledge, they should be able to grow it and make it another revenue stream, or make it their livelihood.
And I'm sure many people are interested in how Pete is doing. How is Pete?
Good. Yeah, he's got a big ranch out in California, and he's spending lots of his time setting that up. As far as
does he still trade?
Oh yeah, we talked. He's certainly behind the screen. It's seeing how he's the ranch manager on a big ranch. He's got a lot of responsibilities there, so it certainly isn't every day open to close. But he's and there's no one more involved in trying to build out new ideas. So we're trying to develop new things, and not so much trading the old stuff, trying to build new and greater and better stuff.
Do you ever think he would come on and teach with you, or all of us?
He's Mr. Throw the old away, and I don't want to talk about it, and we just talk about new stuff. But that might be an opportunity there. But if you want to revert back to anything old, no way.
No way. All right. So it has to be. So everybody, there you go. If we're going to, it could be just a visit from the UFO if Pete shows up.
Right.
But anyway, thank you everybody for coming. I'm going to end it. Stephen, thank you again. It's great to see you.
You too. Yeah. Thanks a lot. We appreciate it.
And of course to Sang Lucci and Charlie and everybody for putting it together and hosting it. And good luck out there. It's dangerous trading, so please be careful. Don't add to losers.
Right. One last note. One thing that Starr would always say is, and I know that Chris doesn't necessarily abide by this one anymore, but over long holiday weekends, markets tend to change direction. So
right.
So with a couple of holidays coming up and the thought processes, people are. This is just for markets that are moving vertically. So if you have a situation where you've had a big run up and people have an extra day or two to think about, time to cash in your chips or let it run, and you got the year end coming up, and people that who have done well ring at the register, and people who haven't done well might be more inclined to not make their situation worse, so they don't get fired or whatever. So yeah, just keep those things in mind. Doesn't mean it's going to happen, but it's always worth noting that.
And it can change direction over a holiday weekend. And here comes a holiday weekend.
Yeah. Yeah.
All right. Thanks, everybody. Talk to you later. Bye.
Okay.